Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Monday, April 28th, 2025. Today's episode begins with our title, Low Volume, TLT Rises, and Stocks Are Flat. With low volume, without any real economic data coming out today, no really major earnings today, the market was generally quiet. There's a number of small things I want to talk about going through the charts when we get there. Before we do that, community topics. What moves, if any, did you make today? Robschild sits on his hands. And coming up, continuous tariff updates. Seems like we've had a good amount of time since the last one. I'm kind of wondering when the next one will come, if there is a next one. Personally, I think the frenemies situation between Powell and Trump is where it needs to be. I don't really see any players having any reason to move anything around, especially since this week we have some big reports that could really grab the headlines' attention and rock the boat and get us to forget about the whole tariff thing even exists for a while, because Tuesday, tomorrow at 10 a.m. we have job openings. If we do indeed have a recession coming, we will see less jobs, along with more people looking for jobs that can't get them, and we get that on Friday in the unemployment rate. And then also we have Wednesday later this week, the very important Q1 GDP report. Like I mentioned on Friday's show, the Atlanta Fed now is forecasting a negative number, which has a strong possibility of marking the beginning of a recession that we might be in already at this point. We also have ADP employment and then PCE data, the inflation gauge. Once PCE gets cool enough, it gives the Fed plenty of space to start cutting. And if you've been following my show for a while, you know little cuts are not going to save inflation from continuing to the downside. Eventually, I expect at least some deflation. Before we move on, thank you for watching, subscribing, commenting, and supporting. No major updates in the daily reminders and macro views. See my website in the description labeled Daily Reminders to read through my explanations of these extremely important items. Also, no major changes in the crystal ball ratings nor the Robschild portfolio. On to the charts, starting with the S&P 500. As is tradition, there's not really anything to talk about since it was low volume and we closed 0.06% higher on the day. I follow a very good chartist named Gareth Soloway. He has a YouTube channel called Verified Investing, and I expressed my disagreement with his viewpoints on Friday, and I'm turning out to be very right so far. He even said this morning he's expecting this wedge here. You can watch his show from this morning. He said this exact wedge he was expecting to wedge up into this corner before breaking out to the upside, and instead the 10-year Treasury note yield dropped very clearly and strongly to the downside, which is what I was expecting and what I had said on Friday. According to him, this should have been something to push stocks much higher, yet stocks were completely flat while this is collapsing. And then if you take a look further out in the yield curve, TLT went up by 0.63% today, opening lower on the open, and just the bulls just driving it higher, all while stocks remained muted. Although Gareth and many others have gotten used to the correlated state of when TLT drops, stocks drop, and when TLT goes up, stocks go up, we are starting to see clear signs of that switching to an uncorrelated state, where you have flat stocks or even stocks going down while there's a rush to safety in Treasury bonds. I think an important way of looking at the bond market versus the stock market is that you should see something like TLT as like the grandfather and the stock market, the S&P 500, like a whiny little kid. You know, the bond market is larger, it's bigger, it's sturdier, and you don't mess with it. While the stock market just reacts to every little piece of news that comes its way. TLT and the S&P 500 can and do often act together in a correlated state, and then, also they can act in an uncorrelated state. And I believe that Trump and Powell and all the powers that be want it to be in an uncorrelated state. They want a rush into treasury bonds because they want lower rates. They don't want runaway fiscal deficits with interest payments that are too large. They need rates to go down. And in order for this to happen, the stock market bubble that we're currently in needs to deflate, period. I think this is largely why we're not hearing any large news coming from Powell or Trump or anybody right now. They're happily sitting on their hands watching the stock market deflate a little bit and watching rates drop. This is what they want, and they're going to do everything they can to make it happen the way that I see it. But what do I know? I'm just a guy with a crystal ball. I think it's important to note that the VIX, the pricing of options contracts, known as the fear gauge, is still not into a calm state below 20. We actually rose in the VIX today by 1.29%, currently at 2516. The VIX index is well prepared for a larger amounts of volatility coming. You have to kill all the bears before things can get bearish. The Skew index is another one that caught my eye recently, as recently we were very high in this index. This prices option contracts that are like way out of the money. And when it's elevated for a long time, it does sort of indicate, hey, something big is coming. And we recently dropped into the bottom range of here again. Like, we got to get rid of as many bears as possible before we can, really get bearish. I think that's exactly what we're seeing today. I also want to note that the Skew index, even sitting at 131, this is a very high range that we've been in for a while. And then before the 2022 correction that we had, you notice that the Skew index was preparing for that beforehand. That tends to be what the Skew index does. And since that dip, it's been elevating, very elevated, and still elevating, not cooling off at all. Scrolling back through history, you can see the rise in the Skew index leading into the great financial crisis. I'm going to also note that, this was peaking out at 141, and here we are today with a bottom at 131. This is just another one of those signs that is screaming to me, on top of all the stuff I have on my website. There are so many things screaming to me that there is something much worse than most people expect. And it could start this Wednesday. HYG, a junk bond ETF, also showing signs of strong complacency back into this previous range where we were basically we hit historic tight credit spreads, meaning that this market, this high yield corporate bond market, has been pricing way lower risk than normal. The same thing happened leading into the great financial crisis. With the stock market, gold, and many other markets sort of stalling out, I'm finding it interesting that the SOFR rate is, it went up a little bit, and this actually updates for the previous trading day, so for Friday. I've said it on many shows before, and I'll say it again, now that we're not worried about the head of the Central Bank of the United States getting fired by the president, which would unstabilize the entire world. It allows the bond market to healthily go up, which is exactly what's happening. And with the SOFR rate rising here, I'm wondering if there's a good amount of institutional money relaxing into treasuries actually right now. Just a guess. Next, I want to talk about SMH, the semiconductor ETF. I noted on Friday, I think it was Friday, that I had to move to a weekly chart because this neckline had been broken. I stand corrected. You know, when we had broken the neckline in the first place, the actual retest was on the April 9th date. And in order for us to have a confirmation candle to break, to have this neckline not count on a daily basis, not that a daily basis even matters, since, like I said before, this head and shoulders pattern goes over the course of a year. So normally, yeah, you would want to use a weekly chart anyway, but the point is, I just want to, it's just a little detail, but I just want to point out that the top of Wednesday, April 9th's candle, we did not get a closing above the wick of that candle, which is what technicians want to see if they need to get out of their shorts, if, you know, that's the one they're looking at, which is oftentimes what they're looking at. So the point is that I thought on a daily basis this neckline was dead, but it is still actually intact here, whether it matters or not on a daily basis. I know I've talked about this chart a lot of times, and I know it's already on my website, but I wanted to have this just be another reminder to add to my daily reminders. If you had gone into a coma halfway through 2022 and you knew how charts worked and you saw this deep and this long of an inversion and then a fight at zero and then again inverting below zero today, this was the first thing you saw when you came out of your coma. If you understand the implications of this, I don't think you would be someone holding very happy about holding stocks. In fact, now that since we haven't had the gray bar yet, you'd probably sell them all today. I feel like sometimes I repeat this too much, but it's something that can't be repeated enough in my strong estimation. When the yield curve gets inverted, that's when the Fed raises rates to strangle the economy, and then once it's done, it's behind, and then you get into a recession every time. 2000, inverted yield curve, gray bar, recession. 2006, inverted yield curve. Coming out of it into the great financial crisis. We even had an inversion before the COVID collapse. And then more recently, we've been inverted for perhaps the longest time in history. And usually the longer the inversion, the worse the eventual outcome, which is actually what I'm expecting. Stay safe out there, guys. And always remember that I'm just a guy with a crystal ball. And that's all for me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.